Look, something just shifted in the silver market that most stackers are completely missing. And I'm not talking about the price hitting $62 an ounce or breaking records. That's just the surface. What's happening underneath is far more significant, and it's creating a path forward that changes everything we thought we knew about stacking precious metals. Let me show you what I mean. 3 days ago, silver touched $64.64 per ounce, record territory. But here's what nobody's talking about. It wasn't retail driving that move. It wasn't stackers like you and me rushing to coin shops. This was institutional money. Big money. The kind of money that moves markets and creates trends that last for years, not days. And then something interesting happened. Silver pulled back to $61.70. A lot of people saw that as profit-taking. A correction, business as usual. But when you dig into the data, when you look at what's actually moving behind the scenes, you realize this pullback is setting up something much bigger. It's creating a new path forward that smart stackers need to understand right now. Here's the signal everyone's missing. The relationship between silver's price action and what's happening in the industrial sector has fundamentally changed. For decades, we've understood silver as both a monetary metal and an industrial commodity. But the balance between those two forces is shifting in a way we haven't seen since the 1970s. Let me paint you a picture of what's really going on. Right now, global silver production is running at about 830 million ounces per year. That number has been relatively flat for the past 5 years. Meanwhile, industrial demand has exploded. Solar panels alone are consuming over 200 million ounces annually, and that number is projected to hit 300 million by 2027. Electric vehicles, 5G infrastructure, medical devices, water purification systems. Every major technological trend of the next decade is silver-intensive. But here's where it gets interesting. Investment demand, the kind driven by stackers and institutions buying physical metal, has been running at about 250 million ounces per year. Add that to industrial demand, and you're looking at total demand exceeding 1.2 billion ounces against production of 830 million ounces. Now, you might be thinking, we've heard about silver deficits before. What's different this time? What's different is the response from the institutional side. Central banks, which have been laser-focused on gold for the past decade, are starting to look at silver differently. Not as a monetary reserve in the traditional sense, but as a strategic industrial resource. And that changes everything. Think about what happened with rare earth elements. For years, they were just obscure materials that nobody paid attention to. Then China started restricting exports, and suddenly every major economy realized they had a strategic vulnerability. Prices exploded. Supply chains got rewritten. Entire industries had to adapt. Silver is heading down a similar path, but with one crucial difference. It's also money. It has 5,000 years of monetary history. And in a world where trust in fiat currencies is eroding, where central banks are printing trillions, where geopolitical tensions are rising, that dual nature creates a unique dynamic. Let me show you what this looks like in practice. 2 weeks ago, the COMEX reported something unusual. Commercial short positions, the big banks and institutions that typically bet against silver, dropped to their lowest level in 3 years. At the same time, large speculators, the hedge funds and trading firms, increased their long positions to levels we haven't seen since 2020. Now, commercial traders are usually the smart money. They have the data, the connections, the inside view of supply and demand. When they reduce their short positions dramatically, it means they see something coming. They're getting out of the way. But here's the really interesting part. While this was happening on the paper market, something else was unfolding in the physical market. Premiums on physical silver, the amount you pay above spot price for actual coins and bars, started climbing. Not dramatically, but steadily. Silver eagles that were trading at $3 over spot 6 months ago are now $5 to $6 over spot. Generic rounds that used to carry a dollar premium are now $2.50 to $3. That spread between paper and physical is telling you something. It's saying that people who want actual metal, who want to hold it in their hands, are willing to pay more. And that premium is sticky. It doesn't come down easily once it establishes itself at a higher level. This is the new signal. This is what changes everything. For years, stackers have been told to just keep stacking. Dollar cost average. Don't worry about the price. And that's been solid advice. But what's happening now creates a different opportunity. A new path forward that goes beyond just accumulating ounces. Let me explain what I mean. The traditional stacking approach is simple. Buy physical silver, hold it long-term, wait for the price to rise. It's a store of value play, a hedge against inflation and currency debasement. And it works, but it's passive. You're essentially betting that at some point in the future, silver will be worth significantly more than it is today. The new path recognizes that we're entering a period where silver's role in the economy is fundamentally changing, where the gap between paper price and physical availability is going to widen, where premiums are going to become a bigger part of the equation, and where understanding the difference between investment silver and strategic silver becomes crucial. Here's what I mean by strategic silver. Investment silver is what most stackers focus on. Generic rounds, bars, government coins. The goal is to accumulate as many ounces as possible at the lowest premium. You're buying weight. You're buying the metal content. And when silver goes to $50 or $75 or $100, you sell and take your profit. Strategic silver is different. It's silver that serves a dual purpose. It's an investment, yes, but it's also positioned to benefit from the structural changes happening in the market. It's silver that will command higher premiums as physical shortages develop. It's silver that has numismatic value or collectability on top of its metal content. It's silver that you can leverage in different ways depending on how the market evolves. Let me give you a concrete example. Right now you can buy a generic silver round for about $32. That's roughly $2.50 over the current spot price of $29.50. Or you can buy a silver eagle for about $35. That's $5.50 over spot. Most stackers would say, why pay the extra $3? It's the same ounce of silver. But here's what they're missing. When physical shortages develop, when premiums start spiking, that silver eagle doesn't just track the spot price. It tracks spot plus an expanding premium. In 2020, when silver went from $12 to $30, silver eagles were trading at $10 to $12 over spot. Generic rounds were at $4 to $5 over spot. If you had bought silver eagles at $3 over spot and sold them at $10 over spot, you made an extra $7 per ounce on top of the spot price appreciation. That's a 233% return on your premium investment. The person who bought generic rounds made money too, but they left a significant amount on the table. Now, I'm not saying everyone should only buy premium products. That's not the point. The point is understanding that the market is changing and different types of silver are going to perform differently in this new environment. Quick aside here, because this is relevant. If you're sitting on $100,000 or more in retirement accounts, I put together a free guide on how gold IRAs work. It covers how to get physical precious metals into your retirement account without tax penalties, and it includes strategies for balancing gold and silver based on your specific situation. It's in the description. Worth checking out if that applies to you. Anyway, back to this new path forward. The signal that's changing everything isn't just about price, it's about market structure. It's about the growing disconnect between paper silver and physical silver, and it's about positioning yourself to benefit from that disconnect. Let me show you what this looks like in the real world. In 2008, during the financial crisis, silver dropped from $20 to $9. Paper silver, the futures contracts, and ETFs collapsed, but physical silver became almost impossible to find. Dealers were sold out. Premiums went through the roof. People who wanted to buy physical couldn't, even though the price was low. Then, as the market recovered, silver went from $9 to $49 in less than 3 years. But here's the key. The people who made the most money weren't the ones who bought at $9 and sold at $49. They were the ones who bought physical at $12 or $15 when it was actually available and held through the entire move. The lesson? Paper price and physical availability don't always align. And when they diverge, physical wins. We're seeing the early stages of that divergence right now. Silver hits $64, pulls back to $61, and everyone focuses on the price action. But the real story is in the premiums, in the delivery delays, in the growing gap between what silver costs on a screen and what it costs to actually own. This is creating a new opportunity structure, a new way to think about stacking. Instead of just accumulating ounces, you start thinking about accumulating the right ounces. The ounces that will hold their value better in a shortage. The ounces that will command higher premiums when physical becomes scarce. The ounces that give you optionality depending on how the market evolves. Let me break this down into practical terms. If you're just starting to stack, your priority is still accumulating weight. Generic rounds and bars make sense. You're building your foundation, but as you build that foundation, you want to start mixing in some strategic pieces. Some silver eagles, some Canadian maples, some older government coins that have both silver content and collectability. If you're an experienced stacker with a solid position, this is the time to start thinking about diversification within your silver holdings. Not just ounces, but types of ounces. Some high-premium government coins, some vintage bars from closed refineries, some fractional silver for liquidity, some larger bars for efficient storage. The goal is to position yourself so that no matter how this market evolves, you're holding silver that will perform well. If it's a straight price move, you benefit. If it's a premium expansion, you benefit. If it's a physical shortage, you benefit. This is the new path. This is what the signal is telling us. Now, let me address the elephant in the room. A lot of stackers are going to say, "This sounds like you're trying to time the market. I thought we were supposed to just stack consistently and not worry about all this." And look, there's wisdom in that approach. Consistency matters. Dollar cost averaging works. But what I'm talking about isn't timing the market, it's understanding the market. It's recognizing that we're in a transition period where the rules are changing and adapting your strategy accordingly. Think about it this way. If you were stacking in 2019 before COVID, the market was stable. Premiums were low. Supply was abundant. The strategy was simple. Buy as many ounces as you can at the lowest price. But then 2020 happened. Mints shut down, supply chains broke, premiums exploded. Suddenly, the strategy had to adapt. The people who recognized that shift early, who understood that physical availability was becoming more important than paper price, those were the people who positioned themselves best. We're in a similar moment right now. The signal is telling us that the market structure is changing, that the relationship between paper and physical is shifting, that premiums are going to become a bigger part of the equation, and that stackers who understand this are going to have an advantage over those who don't. Let me give you another example of what this looks like. Right now, there's a growing trend of industrial users securing long-term silver supply contracts. Solar panel manufacturers, electronics companies, medical device makers. They're not buying on the spot market anymore. They're locking in supply years in advance, often at prices above current spot. Why would they do that? Because they've run the numbers, they've looked at the supply-demand fundamentals, and they've realized that silver availability is going to be a bigger constraint than silver price. They'd rather pay $35 per ounce with guaranteed delivery than risk paying $30 with no guarantee they can actually get the metal when they need it. This is a massive shift. Industrial users are essentially saying, "We don't trust the paper market to deliver physical metal when we need it." And if industrial users don't trust it, why should investors? This is why the premiums are rising. This is why the disconnect between paper and physical is growing. And this is why stackers need to think differently about their strategy. The new path isn't about abandoning the fundamentals of stacking. It's about enhancing them. It's about recognizing that in a market where physical availability is becoming constrained, where premiums are expanding, where the gap between paper and physical is widening, you need to be more strategic about what you buy and when you buy it. Let me show you what this means in practical terms. Say you have $10,000 to invest in silver right now. The old approach would be, buy 312 ounces of generic rounds at $32 each. Simple, straightforward, maximum ounces for your dollar. The new approach might look like this. Buy 200 ounces of generic rounds at $32 each. That's $6,400. Then buy 80 silver eagles at $35 each. That's $2,800. Then buy 20 ounces of fractional silver, maybe some half-ounce or quarter-ounce pieces at $40 per ounce. That's $800. You end up with 300 ounces instead of 312. You lost 12 ounces by paying higher premiums. But here's what you gained: diversification in your silver holdings, exposure to premium expansion, liquidity through fractional pieces, optionality depending on how the market evolves. If silver goes to $50 and premiums stay flat, the old approach wins by a small margin. But if silver goes to $50 and premiums expand, which is what the signal is suggesting, the new approach wins significantly. And if we see physical shortages where certain products become unavailable at any price, the new approach wins dramatically. This is risk management. This is strategic thinking. This is adapting to a changing market. Now I want to talk about timing because this is crucial. The signal we're seeing right now, this shift in market structure, this growing disconnect between paper and physical, it's not going to last forever. There's a window of opportunity here, a period where you can still buy physical silver at reasonable premiums, where supply is still available, where you can position yourself before the broader market catches on. How long is that window? Hard to say exactly, but the indicators suggest we're in the early stages. Premiums are rising, but they're not at crisis levels yet. Supply is tightening, but it's not gone yet. The institutional money is moving in, but retail hasn't fully caught on yet. This is the time to act, not in a panic, not throwing caution to the wind, but with purpose and strategy. This is the time to evaluate your current stack, identify gaps, and make strategic additions that position you for what's coming. Let me tell you a story that illustrates this perfectly. In 2010, I knew a stacker who had been accumulating silver for years. He had about 5,000 ounces, all generic rounds and bars. Solid position. When silver started moving in late 2010, going from $20 to $30 to $40, he was thrilled. He was up huge on paper, but then he tried to sell some of his position at $48, and he ran into a problem. The local dealers were overwhelmed. They had more sellers than buyers. They were offering $3 to $4 under spot because they were already sitting on too much inventory. The online dealers had better prices, but shipping and insurance ate into his profits. Meanwhile, another stacker I knew had a more diversified position. He had generic rounds, but he also had silver eagles, Canadian maples, some vintage bars, some numismatic pieces. When he went to sell at $48, he had options. The silver eagles commanded a premium. The vintage bars attracted collectors. The numismatic pieces sold to a different market entirely. He ended up averaging $51 per ounce on his sales, while the first guy averaged $44. Same spot price, $7 per ounce difference in actual realized value. On a 5,000-ounce position, that's $35,000. The lesson? How you stack matters as much as how much you stack. This is what the new signal is telling us. This is the path forward that changes everything. We're entering a period where silver's role in the global economy is fundamentally shifting, where industrial demand is colliding with investment demand in a way that's creating structural shortages, where the paper market and the physical market are diverging, where premiums are becoming a bigger part of the value equation. Stackers who understand this, who adapt their strategy, who think strategically about what they're buying and why, are going to be positioned incredibly well. Stackers who ignore it, who stick to the old playbook without recognizing the changing dynamics, are going to leave money on the table. Now, let me address one more thing before we wrap up. Some people are going to hear this and think, this sounds complicated. I just want to buy silver and hold it. I don't want to think about premiums and market structure and all this other stuff. And I get it. Simplicity has value. But here's the thing. The market is changing whether you pay attention to it or not. The disconnect between paper and physical is growing whether you acknowledge it or not. The premiums are expanding whether you factor them into your strategy or not. You can choose to ignore these changes and hope for the best, or you can choose to understand them and position yourself accordingly. One approach is passive, the other is strategic. Both can work, but one is going to work significantly better. Think about it this way. If you're driving from New York to Los Angeles, you can just point your car west and start driving. You'll probably get there eventually. Or you can look at a map, plan your route, identify the best roads, avoid the traffic, and make the trip more efficiently. Both approaches get you to the destination, but one is clearly better than the other. That's what we're talking about here. The destination is the same, accumulating wealth through silver. But the route is changing. The road conditions are different. and the stackers who adapt their navigation are going to have a smoother, more profitable journey. So, what does this mean for you, right now, today? First, evaluate your current position. Look at what you're holding. Is it all generic? Is it all premium products? Is it diversified? Are there gaps in your strategy? Second, think about your goals. Are you stacking for long-term wealth preservation? Are you looking for profit opportunities? Are you preparing for a currency crisis? Different goals require different strategies. Third, consider the current market dynamics. Premiums are rising but still reasonable. Supply is available but tightening. Prices are elevated but not at extremes. This is a good environment to make strategic additions. Fourth, take action. Don't overthink it. Don't wait for the perfect moment. The signal is here. The path forward is clear. Start positioning yourself now. The stackers who are going to thrive in the next phase of this market are the ones who recognize that something fundamental has changed, that the old rules don't fully apply anymore, that a new path forward has emerged. This isn't about abandoning the core principles of stacking. It's about enhancing them. It's about being strategic in a market that's becoming more complex and more opportunity-rich at the same time. The signal is clear. Silver's role in the global economy is changing. The relationship between paper and physical is shifting. The premium structure is evolving. And stackers who understand these dynamics are going to be positioned incredibly well for what's coming next. This is your moment. This is your opportunity. This is the new path forward that changes everything. The question is, are you going to take it?